Maybe we'll give it 1 more minute, wait for people to settle in. Perfect. Then I'd say we rumble. So good afternoon, everyone here at the venue, and good morning, good afternoon, and good evening to everyone joining us online. I hope you can all hear me well. Perfect. So greetings from sunny Sharm el-Sheikh here in Egypt at COP27. Hopefully the good weather and the good mood so far will spill over into the climate negotiations that are starting today. So my name is Lennart. I'm advisor for sustainable finance at the Luxembourg Ministry of Finance. I'm also a board member of the Luxembourg Sustainable Finance Initiative, who's organizing this event today. And we're here today to talk about blended finance. It's one of my favorite topics, so I'm very excited. Also, I'm honored and again very excited to have 4 amazing people with me today. So first we have Joan from Convergence. Joan is the CEO, and Convergence is the global network for blended finance based in Canada. So welcome, Joan. Then we have Jay from Lightsmith. Jay is a co-founder and managing director, and the Lightsmith Group is an impact fund manager based in the US. Then we have Alessandra from Blue Orchard. Alessandra is head of blended finance, and Blue Orchard is a Swiss impact fund manager. And online, floating around somewhere in space, we have Arnaud from Impact. Arnaud is co-founder and partner, and Impact is an impact finance consulting company based in Luxembourg. So all of these amazing people have extensive experience with blended finance, and that's what we will explore and discuss today. So we'll start with an interview with Joan, so the CEO of Convergence, and then we'll have a panel discussion with the other 3 speakers, where we hear about their direct experience with blended finance and the blended finance projects that they are working on at the moment. I'm very excited to have these speakers because Convergence really is the global reference for blended finance, and the other speakers have very exciting and also slightly different projects where they use blended finance as a tool. So one is it's a private equity investment fund that does direct investments in companies. One is an impact fund of funds that does investments in mainly private equity impact funds. And one is a liquidity guarantee facility, which is a whole different animal. So it's exciting to look at those. We will also have some time at the end for questions. So if something comes up, scribble it down. We have 20 minutes at the end to do that live here, but also online. My colleague Maria, she's checking the questions online. So if something comes up, send it in the chat, and then we'll get back to that at the end. Okay, so let's start with Convergence to set the scene for blended finance. And I'll just take a seat. Hello? Good. Oh, one more test. Arnaud, can you hear us online? Yes? Okay, good. So, Joan, how are you today in the hustle and bustle of COP?
Yeah, we have to share. I'm doing great. It's great to be here, and hello to everybody online as well as in the room.
I think we'll try. Let's try this. Okay, good. So tell us a little bit about Convergence in general.
Sure. We've been around for about 7 years, and we're pretty excited that in those 7 years, this whole subject has gone pretty mainstream. That's not where we were when we launched in 2016. So Convergence is the global network for blended finance. And what we do is produce data and market insights and a community for those who are in our membership and are using blended finance to try to get deals done. We also try to accelerate deal flow by taking in third-party grants, and on a competitive basis, we issue grants for very early stage ideas that we think can use blended finance to attract commercial money at scale in replicable transactions. So it's data, intel, and market acceleration.
Perfect, thank you. So the main question, what is blended finance?
What is blended finance? Like I said, I'm pretty excited that there are probably people in the audience who could do this just as well as I can now. So blended finance is the use of catalytic money. Imagine money from a foundation or from an aid agency. That use of that kind of money to attract commercial money, and I'm talking about private sector commercial money in our definition, into sustainable investing in emerging markets. There are other definitions out there, but we were created to drive private sector investment. So our definition always includes a private sector investor. So blended finance is just the smart use of one kind of capital in limited form to attract the larger source of capital, private money, into the developing markets toward the SDGs.
Thank you. So from my own experience as well, blended finance usually tries to encourage investments also in developing countries or in different sectors that might not have that much of a track record. Is that so?
Yeah, you really should not use aid money or philanthropic money to encourage private sector investors if they were already going to go do something. So blended finance is always trying to correct for something or solve for something that is a problem that is keeping that money from going where a development actor or a philanthropic actor would want to see money going. So blended finance can be used where there's high perceived risk. People just don't know what they're getting into because they've never been in this market or they've never tried this kind of structure. And real risk. A lot of these markets that we work in have real country risk, currency volatility, off-takers who are not market, who are not credit-worthy. There are a lot of real risks. So it solves for perceived risks and real risks. Blended finance is also good at speeding things up, at accelerating. So if you imagine that somebody out there can put a deal together but is going to have to prove that it works in order to get deal number 2 started, they're going to spend a long time proving out deal number 1, and sometimes a blended finance transaction can go a little bit faster and get things into the market to prove the point a little bit faster.
So why is blended finance so important, and what impact can it really have?
Yeah, well, if you think about it, we just hit a high water mark for official development aid going into developing markets because of COVID, because of Ukraine. We hit, I think, 179 billion was the last count. That's the most annual number, the highest annual number of development aid that's gone into the developing markets for a long, long time, possibly ever. And all of that aid money, plus all of the multilateral development banks doing their work, all told mobilized $40 billion last year. So we're not getting enough private sector money into these markets. And meanwhile, of course, we all know the private capital or the capital markets operate in the trillions. So the question is, how do you use a little bit of that ODA, that official development money, and philanthropic money to get much more money into these markets? So we have a potential, if we do this right, to have a breakthrough in the quantum of money aiming at the markets that really need it. By the way, it's not the way we're going to solve the problem. I can sit here and tell you blended finance is wonderful stuff, but it's one tool, and there are other tools. We need regulations. You know, we have currency issues. There are a whole lot of other issues that cannot be single-handedly solved with blended finance. I don't want you to walk out of here thinking that's what I said. It's one tool. It's an important tool. It can be transformational, wrapped around other solutions as well.
No, that's a really good point to make. And how much of it, as of now, is about really climate investments?
Yeah, so the annual, we have probably the best data, definitely have the best data in the business, I think. We track how many deals happen every year that are blended. Deal being fund, project, company, you name it. The average blended finance volume in the emerging markets per year is around $11 billion. And this year, we've just issued our State of Blended Finance report. It's public, it's free, you're all welcome to download it. And we wrote specifically about climate this year because although we are not climate specialists, it was our way of contributing to the issue. And what we have noticed is that about half of the blended finance transactions we've ever seen deal with something around climate, half of them. And if you look at volume of money, about 2/3 of the money that has closed in blended finance transactions has been in transactions that have something to do with climate. So there's a lot of climate investing out there that doesn't need blending, and that's wonderful stuff, but in our markets, there's a significant amount of it that needs blending. So the two fields, climate investing and blended finance as a tool, overlap considerably.
Thank you. Maybe another question. I'm going off the path a little bit, so I hope I don't put you on the spot. But I remember we spoke at the beginning of the year, I think it was, about the accelerator that you're currently setting up. And we still have a bit of time, so maybe I'll give you that opportunity to advertise a little bit what you're doing with the accelerator.
Thank you very much. It's nice to be able to do an advertisement in the middle of a comment. So we have mentioned before that we feel that the field of blended finance is too fractured, it's too siloed. And Convergence has for a long time worked informally with a partner climate policy initiative, CPI. We've decided to put some of our tools together. So we have launched a target $100 million granting facility. And what we envision it doing is using the granting machinery that's already in operations at Convergence and the climate specialty of CPI. And we're going to, we're fundraising for it, but the idea is to put out calls for proposals in the market for early stage concepts that we can back with money from Convergence as well as technical support from CPI as a specialist in the field. We have some interested donors, but we have a long way to go, and I appreciate your asking.
Yeah, no, I think it's a great initiative. Great, thank you so much, Joan. You can get in touch with Convergence through their website. It's convergence.finance. And also, I think last week you published the report that I think you do every year. It's the State of Blended Finance. So this one's the State of Blended Finance 2022, which also, again, is hands down the best source of information on blended finance you can find. So thank you very much, Joan.
Thank you very much.
So we'll try to switch the microphones. Great, okay, so I'll turn the other way now. So welcome to the three of you again, with Arnaud floating somewhere above us. Perfect. So we'll start with a little bit of an introduction to all of you, and then after that I'll ask some more questions. So we'll try to go like it is on the slide. So let's start with Alessandra from Blue Orchard. So please quickly introduce yourself, Blue Orchard, and also the fund project that you're working on. And we'll change the slide.
I hope you can hear me all right. Super. So good morning and good afternoon, everyone. And first of all, thanks a lot to the Ministry of Finance of Luxembourg and LSFI for having us today. Maybe I'll start with a few words about Blue Orchard as an organization, and then I'll go and deep dive in one of our blended finance initiatives that you can already see on the screen. So Blue Orchard is an impact asset manager that has more than 20 years experience in impact finance across emerging and frontier markets. So we have, let's say, our blended finance practice that is very relevant in terms of strategy for us, because we have been using that across different asset classes and impact themes. So effectively to date, we have 7 active initiatives in blended finance that counts for approximately $1 billion USD of asset under management. And as I said, so historically our expertise is in financial inclusion and private debt, but we expanded over the years in other asset classes such as private equity, sustainable infrastructure, and of course climate has become a very relevant topic for us. Today I wanted to showcase this project that we are working on together with the government of Luxembourg and Schroders. As Lennart mentioned before, as opposed to other initiatives that we manage that are direct investments into either financial institutions or companies, this time it's a fund of funds strategy, which means that effectively we will be making investment in other fund managers. So if I look at this strategy, so the name is Green Earth Impact Fund, or in short, GAIF. It's part of a broader initiative that the Luxembourg government is carrying on. The project has, let's say, a mission that I would say is threefold. So first of all, the objective is to strengthen the sustainable finance ecosystem. Second, to contribute to the transition to climate neutral economies. And third, to achieve sustainable growth in emerging and developing markets where it's going to be investing. To do that, what we will be doing is investments in private equity funds, sustainable real asset funds that would include sustainable infrastructure, but also sustainable real estate. So for instance, green buildings, if we will find the right opportunities, and let's say opportunistically also in private debt funds. The idea is to address through these investments 4 impact themes: climate adaptation, climate mitigation, protection and sustainable use of water and marine resources, and protection and restoration of biodiversity and ecosystems. So to do so, we work together with the colleagues at the Ministry of Finance, and we thought that indeed a blended finance structure was needed. But maybe I'll stop here and I'll pass it over, not to leave some suspense before we enter into the blended finance structure itself. Thank you.
Perfect. Thank you very much. Okay, we'll move over to Arnaud, who can hopefully hear us and we can hopefully hear him. If you could quickly introduce yourself and impact and the facility you're working on.
Do you hear me? Yes, you hear me. Good. Good afternoon, everyone. And yes, sorry for that. I'm not with you today. I had other logistical issues, but I'm glad to be invited to talk about a solution we're bringing forward for climate finance and impact investing. So my name is Arnaud Gillin, the co-founder of Impact. As Lennart just mentioned, we are active since 2007 in impact investing in Luxembourg. So our aim or mission, if you like, as a company consulting and fund management support company, is to facilitate the development of impact and climate finance at large. So what we've done over the last 15 years, we've helped institutions like development finance institutions, international institutions like the UN, GCF, not-for-profits such as, for example, the Nature Conservancy, and fund managers to establish their impact funds and climate funds, where we guide them through a whole structuring exercise in terms of legal aspect, governance aspect, financial structuring, and the impact management side of the impact funds. So we've set up 33 funds in total over the last 15 years, and in most cases these funds are indeed blended finance structures. Because what we see, as Joan just mentioned, is impact investing is in a lot of cases still seen as a relatively risky, unknown investment strategy, long-term strategy, illiquid strategy, which has in a lot of cases also emerging market, let's say, focus, and therefore kind of a country risk perspective for investors. So you need indeed some protection to attract more private investors. But here, I'm not here to talk about that, but to give you a hint about another aspect that, let's say, put some barriers for more private money going into impact investing, and where we would be using the blended finance aspect to actually cater for that. You have behind 4 panelists a very technical chart, not very glossy with nice pictures, but in a nutshell, it explains what the facility would be doing. So in impact investing, not only we talk about emerging market risk, unknown investment strategy, but we talk also about long-term view. You don't generate the impact in 1 or 2 years. You don't plant trees, and after 2 years you chop the tree if an investor wants to exit. And so by nature, impact investing is a long-term approach. So that's why when we create funds, we talk about limited duration fund of 10, 15 years. So for a lot of investors, when they invest into a fund, they are somehow stuck in the fund for 10 or 15 years. So I would say for 2/3 of the private investors worldwide, this is a problem, because they are either excluded due to regulation, like private investors, or due to their internal risk control or perception to invest into these illiquid long-term funds. So we're missing a lot of the, let's say, private wealth in the market that is willing to support impact investing, but is simply excluded. So what we are creating with a set of impact actors is a new facility that would help private investors to invest into illiquid climate impact funds. So even if the fund is there to invest into long-term strategies for 10, 15, 20 years when we talk about forestry, we would provide these private investors with an exit option. So a possibility to exit if they have to exit the fund, and whereby we would buy their stake into the illiquid impact fund at a certain way of valuing their asset, but this is more technical. But just by doing so, we enable more private investors to get into climate finance at large. Because they will now tick the box and say, I have an exit option, I can exit this investment. It's not that I want to exit, but I need to have the possibility to exit. And to do so, and again, just like Masandra did, I won't go into the technical aspects right now, but we need public money. We need public money to actually provide this liquidity to these private impact investors. And this quite complex structure that you see that is using the different ways of getting funding from governments, from foundations, from development finance institutions to actually create a fund that would be able to provide these liquidity guarantees to these impact investors, so that after year 4 or 5, they have to exit the fund, they can sell their stake to this liquidity guarantee facility, and then this octogonal facility will then sell it back into the market, thereby creating a secondary market for impact investing. So it is relatively indirect, but you see that through blended finance, we are able to tackle the different issues that we have in impact investing. Joan mentioned credit risk, we mentioned FX risk, and here is another risk, which is liquidity risk. And I think that's the innovation that we can do thanks to public money to actually catalyze even more private investors and try to solve some of their issues when they look for investing into climate impact funds.
Thank you, Arnaud. Jay, let's move to you. Quick introduction of yourself, of the Lightsmith Group, and of the fund.
Thanks so much, Leonard, and it's a great pleasure to be on such an esteemed panel with Joan and Alessandra and old friends like Arnaud as well. And I always feel very at home in the Luxembourg EIB pavilion here. We are an Article 9 Luxembourg-based fund and are very happy to be partnered with the Luxembourg government. So my name is Jay Coe. I'm one of the co-founders and managing directors at Lightsmith. As you can see on the slide, Lightsmith is a global private equity fund that is focused on climate resilience and adaptation, a critical part of the climate action agenda. And the basic idea that we have, and I'll talk about how blended finance falls into it, is that there's an extremely strong need that will just grow over the next years and decades to begin to scale up the capacity to deal with the adaptation and climate resilience challenges ahead of us. Climate change is already here. It's a humanitarian tragedy that's unfolding before our eyes. It's also impacting the real economy and society. And the question is, what are we going to do about it? So the most recent report just released, the Adaptation Finance Report, Adaptation Gap Report for 2022 now reports that up to $340 billion per year in emerging markets alone will be required by 2030 simply to deal with the challenges of adaptation. And yet, in the latest analysis by the Climate Policy Initiative, one of Joan's partners, less than 8% of all climate finance has anything to do with adaptation, and still less than $500 million in the private sector has been tracked that addresses adaptation. So this enormous, inevitable challenge, even at 1.5 degrees, we have enormous changes that will happen to society, the people on the planet, and yet we're still not mobilizing capital and technology and entrepreneurship to deal with it. So how do we address that issue? And one of the answers, as Joan has said, is blended finance. And so the CRAFT fund vehicle, the Climate Resilience and Adaptation Finance and Technology Transfer Facility, is the first private investment strategy for adaptation and climate resilience. So what it does is use a blended finance structure where junior investors have catalyzed commercially oriented investors to begin to mobilize capital for climate finance. So it reached final close earlier this year at $185 billion. We're very, very happy that the Luxembourg government and the European Investment Bank were two of the first closed investors to actually launch this first strategy for private sector adaptation investment. And that itself has begun deploying capital and has already invested in 3 companies, one of which is represented here. Rob Bartrop is here from Source Global, a solar hydro panels company we'll talk a little bit about that has unique technology to really address the challenge that's increasing around the world for the need for safe drinking water. So the blended finance structure of CRAFT enabled junior capital to crowd in senior capital that enables us now to begin for the first time to invest in technologies that can scale up to deal with adaptation. What we're here at COP this year to talk about is that second, I think, thing on the chart here, which is CRAFT TA. So the fund itself is also designed to accelerate the deployment of technologies it's investing in on a commercial basis into the areas where it's most needed today. Vulnerable populations in developing countries, low-income countries, small island developing states. So these are some of the most vulnerable communities in the world today and have contributed the least to the mitigation challenge ahead of us on the greenhouse gas emission side. So the question we wanted to answer is if we can scale commercially adaptation technologies like water technologies and expand them, that'll create capacity on a commercial basis to begin to address the scope of the problem we're going to need as climate change goes forward. But what about those most vulnerable countries today? What about low-income countries? What about small island developers? How do you reach the technology into those places? How do you transfer and deploy that today? So we set up separately, together with the Nordic Development Fund and the U.S. State Department, is a technical assistance facility targeted specifically at piloting and deploying the technologies invested in by the CRAFT commercial fund vehicle into those communities now. And we're very pleased that we'll be announcing a little bit later today the first of those projects deploying technologies supported by the CRAFT fund into one of the small island developing states that demonstrates that commitments made last year can actually be executed at the next COP. So what I'd like to just sort of step back and say is, when we talk about blended finance, the problem you may try to solve at a point in time is how do you reduce the risk for the commercially oriented investor to come into the space? And the structure of the CRAFT vehicle has done that. So we have junior and senior investors in that vehicle. But we should also consider the idea of blended finance over time. So small amounts of grant funding that can prepare projects, that can deploy projects, that can pilot projects, can then lead to dramatically higher deployment of commercial finance. So small amounts of grant funding that can unlock hundreds of millions or billions of dollars of projects is another way that we can use blended finance to actually execute this problem. So we can talk more about that in a moment.
Great, thank you very much. Yeah, that is the next kind of round I wanted to do with each of you to, and even though we've addressed it a little bit already, but I think it's important for people to take the time to fully understand in what way the different initiatives really make use of blended finance specifically. So maybe we'll start with Alessandra.
Yes, and I tried to leave the suspense earlier, but my colleagues, they spoil it already, so I'll try to build on what has been said by Jay Arnaud and the other colleagues. So I think it's important to remember that blended finance is a tool, right? So again, it's very relevant, the ecosystem that is around, and in this respect also technical assistance capital, it's crucial. Maybe I'll focus on the example that we brought today. So in this case, what we try to do, and I think as Blue Orchard we always try to play the private sector advocate, right? So private sector, so pension funds, family offices, private banks, they don't want complexity in structures, right? So sometimes when you negotiate with the DFIs, with the development agency, things can get kind of complicated, right? And so with this structure, what we have tried to do and to achieve is to put together a structure that is simple enough for the private sector to invest in. So this is done in different ways, right? So the first thing is that in terms of blended finance mechanism, it's simple because it's a multi-layer fund of funds, that's right, but it's only 2 layers effectively. So you have a junior tranche where actually we will welcome alongside with the Ministry of Finance of Luxembourg other contributors. And then you have on top of that the senior tranche where we expect the private sector to come in. So this mechanism actually allows for the private sector to benefit from, let's say, capital protection. So in case of credit losses or adverse effect movements, there is a cushion underneath that would protect them. And on top of that, of course, it's important to consider also the financial perspective, right? So again, the risk perspective and the financial perspective. So from a financial perspective, they will be paid first, right? They will be paid first in terms of distribution of income, but they will also be paid first in terms of distribution of their capital when it's time to start repaying them. And so they are in a very privileged position, let's say. So now, the reason why we need a blended finance structure for this type of initiative is because, as we said, I mean, and I guess this is all over the panels at COP, it's complicated, and sorry, we are fighting against flies here on stage. It's complicated to finance transactions when it comes to climate finance. In particular, and I think that, again, the state of blended finance that on an annual basis is published by Convergence is a very good source for us, and for myself, it's kind of the Bible. It's obvious that you have mitigation initiatives, but when it comes to adaptation, already you see a drop in terms of offer. And if you go even further, so if you look, for example, I'm referencing the slide, if you look for initiatives that support forestry, reforestation, biodiversity, sustainable use of water and marine resources, then the offer becomes very small. And even if there is, it's difficult to finance it, right? So the idea here is like, okay, we cannot as Blue Orchard be specialists in all of these impact themes, but we want also to learn from others. And we want to make sure that others' initiatives can be financed so that the private sector can invest, let's say, in a bucket that has different climate finance strategies that they would not invest otherwise directly, right? So for them, again, from a risk and financial perspective, it makes sense because they get what they would potentially get from more commercial strategies. And for us, it makes sense because we are additional to the market. We give the opportunity to the private sector to invest there and to these initiatives to scale, which is effectively what is relevant in the end, right? To make initiatives scalable.
Great, thank you. Well, same question. Let's go to Arnaud. So how does your initiative make use of blended finance?
As you can see from the slide, it's all over the place, blended finance as ever, because we need that for this rather complex service. So back to what I explained. This is a service for private investors that are investing into illiquid investment strategies, for them to be able to exit this if they have to. So as I said, for example, you're entering into a forestry fund. These are very long-term funds because trees don't grow in 2 years, obviously, and so they are 20 years, 25 years. And you say, well, I'd like to invest into that. I'm ready to take the risk. I want to generate the impact. But if I have, as a private individual, or even as a private institutional investor, I have to exit, I need to be able to do so. So we've created this entity, which is called Octone, which is in a way creating what is not existing in impact investing. Where we are lacking in impact and climate investing is that there is no what we can call a secondary market. So a secondary market, which is what we have in what we call in the listed strategies, where you can buy and sell your stakes on a stock market from one day to the other, enables you to take some decision. If you don't like this decision anymore, you can switch. If you need the money back, you can sell back into the stock exchange. But this is not the case in climate finance. There's no organized, and hopefully, I don't know, Convergence could take this role at some point, who knows, or other network could do this. There's no organized market where people could trade. I'm investing into this forestry fund, I want to exit. Are you interested? Yes, I'm interested because it just, now I see what is in the portfolio, I see all the impact generated, and I want to be exposed to that. There's no one that has organized it. So the really long-term view of our initiative is to create this secondary market where people could then exchange the impact, stay as long as they can, but if they have to get their money back, they can do that. And with that, the intention is to increase the flow into impact investing. So what we need to create is an institution that is solid enough to be able to provide these guarantees so that these investors are trusting this facility that if they have to exit, this facility will be able to buy their stakes. So we're talking here about billions. We're really talking about creating a new market actor. Just like for the ones who are aware, in the DFIs got together already 15 years ago to create an actor to tackle the FX risk issue. And the fund is called the Currency Exchange Fund. The Currency Exchange Fund created local currency risk hedging instruments for countries where there's no market at all. There's no Citibank, there's no Goldman Sachs, there's no big bank providing this hedging instrument. And thanks to this fund, a lot of more development finance just happened. So we're creating an institution of the same scale with the intention to attract at least around $5 billion of new private investor money into climate funds, into impact finance. And the only way you can do that is through a blended approach. As you can see in this quite complex stack, we are trenching the various actors that we can see. So we take government money, we're in discussion with the European Union and with other governments to provide junior equity to create this institution. And then we're in discussion with development finance institution that would be senior in terms of risk. And then, because this facility need to have access to a high level of cash, if all the guarantee parties need to sell their stakes at the same moment, think of the financial crisis in 2008, for example, we need to get access to cash. And the only way to get access to cash is from banks, private banks. And these private banks would only lend us the cash if they are guaranteed. So again, we are currently discussing to have a public institution guarantee at scale to reach these 5 billion. So we are using the different, let's say, blended finance providers at different stages of this facility, always in the same spirit to get more private investor money going into these illiquid climate impact funds. And we talked about technical assistance. This facility will also have a technical assistance as part of the his services to the impact funds to help them improve the way they would report to their private investors about the impact they are generating. So the intention is really to create a tool for the market to see more Wright-Smith craft product being funded by private investors, the fund of funds of Blue Shirt and the Luxembourg government, finding more private investors, and then basically giving them no reason anymore to say, no, I cannot invest. For the moment, it's, no, it's too risky. No worries, we have a first loss piece. No, it's too illiquid. No worries, now we have this liquidity guarantee facility. And that's what I think the whole market is trying to do, and initiatives like Convergence are doing, which we're trying through this catalytic effect of public institution, which is not anymore to take the role of directly investing, but helping others to invest. I think that's what the whole industry is trying to do. Sometimes a bit too complex, but as mentioned by Alessandra, at least to the eyes of the private investors, they won't see all this complexity of the facility. For them, it's just simple. I will have a guarantee that if I have to exit, I can sell my stakes to someone. And this is very simple. And we will have a rating so that the private investors can trust us. I think that's in a bit of a version of what the whole sector is doing. We're trying through maybe complex situation, but to ease the life for more private investors to join us.
Thank you, Arnaud. Now, same question to you, Jay. How does your initiative make use of blended finance?
Yeah, so again, I'll talk about the two main ideas that we've been working on, and also mention the ASAP program, the Adaptation SME Accelerator Project, which is another example of using certain kinds of blended instruments to actually launch private sector or small or medium-sized enterprises that do adaptation. But in the craft fund itself, the idea here was to actually take almost financial technology from the early days of renewable energy, where you could actually try to crowd in private sector capital or commercially oriented capital into investments in new areas like renewable energy before it was well proven. So in adaptation, to start the very first private investment strategy in adaptation, we needed at least some capital that could encourage other capital to come in, to create a risk mitigation and potential enhanced incentive for that capital to participate and address the sources of capital problem. How do you mobilize capital? On the uses of capital side, we're actually taking that capital then and deploying it to generate commercial returns for both the junior and senior capital investors in a blended way that actually rewards the senior capital and enables that entire market to really get started. So the Luxembourg government, EIB, and others participate alongside other government institutions, multilaterals, but also again, alongside private philanthropy, the Rockefeller Foundation, and private sector institutional investors, family offices, and insurance companies, for example, that really want to understand for the first time, are there returns to be generated in adaptation investing? So in the craft investment vehicle itself, that blending has enabled us to catalyze that 185 million, the first private investment vehicle dedicated to investing in adaptation and climate resilience. So Lightsmith's very proud to be a partner with the Luxembourg government and EIB and others in that strategy. The second part of the strategy is really to address this blending over time. How do you address the fact that some of the commercial deployment of the technology is simply not at this point, at this cost point, at this moment in time, going to reach some of the smallest and some of the poorest and some of the most vulnerable markets. And so this second component, the technical assistance facility, isn't general grant funding to help increase capacity, but really targeted so that it actually leads to deployment of technologies and the piloting of those technologies in those markets which would ordinarily not be reached for maybe several years or even longer. So the technical assistance facility for craft, which we announced the launch of last year together with the U.S. State Department, the Nordic Development Fund, that 4 million, which could be scaled up to as much as 20 or 100 million of grant funding, is really designed to specifically enable the piloting of that technology in low-income countries and small and developing states. And we'll talk more about those specific examples. But that's a real blending over time. If you can prove a business model, so for example, in the hydro panels example, these are Source Global's solar-powered panels that generate, instead of electricity, they generate pure drinking water, 6 to 9 liters of pure drinking water, almost under any conditions around the world. It's deployed in about 50 countries around the world. How can we take those panels, which have a cost point today that's coming down, just like solar PV panels came down over time? How do we actually get those panels into the hands of those folks that need that drinking water immediately in low-income countries, in small undeveloping states, in vulnerable populations? And so we're using some of that technical assistance for is to pilot pay-as-you-go water for solar, just as we piloted pay-as-you-go electricity, to prove if you finance that panel's cost over the 15-year life cycle of that panel, we can actually create a tariff structure that's affordable and cheaper than bottled water, cheaper than containerized or desalinated water for those populations immediately. Just as we proved pay-as-you-go solar electricity, if we can prove pay-as-you-go water on a piloted basis in these low-income countries or small and developing states, that unlocks the ability to do hundreds of millions of dollars of these types of projects on a commercial basis and sort of do the replication of what we saw in solar electricity in solar water. And so that's the kind of opportunity that I think is before us by using small amounts of public funding on a grant basis or on a junior basis or on a risk mitigation basis to unlock what is going to be the future. I think the most important thing about this COP that's different than the last 26 COPs, I guess, is this supposed to be about implementation, and I think the urgency that we have around implementation at this point is even sharper than ever. So what we really need is an all-of-the-above strategy where commercial capital that can be deployed today is being deployed, where we can use small amounts of junior capital to accelerate the deployment of commercial capital on a much larger basis. And we can use grant capital that can set the stage, grant funding, to set the stage for the deployment and expansion and scaling up of that commercial capital in future periods. If we are at a COP 37, which I hope by then we'll have done a lot more to address the climate problem, the thing that I think is absolutely going to be clear by then is that climate change will have occurred, continue to unfold, even on a 1.5 degree basis. Enormous amounts of change and impact will have occurred. And the question that we face right now is, what did we choose to do about it today? Did we invest? Did we deploy technology? Did we harness entrepreneurship? Did we take small amounts of funding today that look small but unlocked by the time we got to 10 years from now enormous amounts of industry, innovation, technology, entrepreneurship in a way that actually protects our society, makes it more resilient, makes it more adapted, and in a way that actually is a net zero way. So I would encourage all of you to think about blended finance as a solution that can help mitigate risk today and scale capital immediately, but also to be used over time to actually scale up the solutions we're going to need 2 years, 5 years, 10 years, 20 years from now. That's the only way we're going to get there.
Great, thank you very much, Jay. So before we go to questions from the audience, I wanted to do one more round. So what we're trying to do here as well is educate people about blended finance and try to get more blended finance instruments on the market and get more people to do blended finance investments in junior tranches. So I know all of you have already touched on those points, but what have really been, or how has the junior capital really benefited your fund? So maybe we'll start with Alessandra, because yours is also a fund of fund structure. So how is the junior capital really benefiting your fund structure?
Yes, so again, I mean, there are two sides of the same coin, right? So there is the liability side where you see that junior capital in the structure is beneficial for the private investors that would be crowded in by debt. And on the other side, you see the benefit on the asset side. So with this fund of fund strategy, we will have the opportunity to take junior positions for a limited portion of the portfolio allocation, but still some part of it, into these strategies that I mentioned before are difficult to finance by the private sector, right? So again, if you think about very niche and specific strategies, for example, about carbon impact solution, forestry funds, there again, they also need blended finance. So somehow it's going to be a blended finance structure financing other blended finance structure, with the hope that this type of initiatives will become more and more, because again, I think today the issue is also that in terms of offer of these strategies, there is not much out there, and it's not, certainly it's not enough to fill the gap that we see in terms of finance that is needed for tackling climate change. And so if you want, with a fund of fund strategy, what we are trying to achieve is twofold. So on the liability side, convince the private sector to come in and to catalyze their capital, to bring the potential of the investments to scale, And on the other side of the coin, so the asset side, is really to try to support initiatives that are working on the field of climate finance.
Great, thank you. And it makes me think just of a story. Alessandra and I, we went to see a private bank a few weeks ago to explain the whole fund concept. And it was really interesting, and that's why I speak about education as well around blended finance, because we spoke to the private bank, and what we try is for them to invest in the fund. And so they would invest in the senior tranche, and we as the ministry, we invest in the junior tranche. And so they didn't understand the different tranches, and so we explained, so it's a 250 million investment fund, out of which around 50 million will be junior capital. And so the ministry, for example, invests in the junior capital alongside a foundation, and they take more risk, which means when the bank invests in the senior tranche and something goes wrong, they don't lose their return, but the junior capital loses their return. And so we explained this a few times, because at the beginning they thought they would invest in the junior tranche, and so then we explained everything, and they said, but that's amazing.
It's too good to be true, they said.
Yeah, they said, but this is an amazing deal for a private bank. And we said, yes, we know, that's why we're doing this, because now I don't know all the numbers by heart. I think it's how much do we need to mobilize to reach the SDGs by 2030? I think it's around $4 trillion a year. We have a gap of $1.7 trillion, I think, a year. So that gap we really need to fill. And so once you have that storytelling in place of the whole world has goals until 2030, but we are right now not achieving them, and so we need to mobilize that capital from the private sector, and this is one of the tools that we use in order to make it more appealing for private banks to use money from their private clients to invest in these types of structure. But it's just a really funny conversation, but good in the end. So hopefully we mobilize that private bank to invest in these types of funds. Arnaud, maybe we'll get to you about the specific benefits of the blended finance approach for your instrument.
I think we touched upon most of them. I think what you didn't explain, Mehmet, is also that usually these public money not only is protecting private money, but is usually there mainly or solely for the impact. So what the public institution is looking for is really catalyzing private money to increase the impact that they could have, rather than investing their own 10 million, 100 million directly into the project. Thanks to that, they could catalyze 5 times, 10 times more money into this. So they have what we call a leverage factor. And this ratio, this leverage factor, is always what speaks to the public institutions, because they are not here to generate return, they are here to generate impact. And so I think what is good in this approach is that even if they usually take more risk than private investors, they don't require a return on investment that is in line with the risk they are taking. You would talk to a private investor and say, you take a bit more risk, then okay, fine, but then I need a higher return than the others. That's the usual way of risk return that we see in the market. The beauty with public institutions, not that they're stupid, but they really understand their role, is to say, let's go into these strategies that are more risky and maybe not fully compensating the investors for the risk that they're taking. So usually if you come directly with a fund that is investing in the emerging market with a new investment strategy, all investors will say, well, then I need 20-25% of expected return for me to invest into that. Maybe after the fund number 2, number 3, number 4, whatever you will have shown to me that it's not that risky, but it has a good return, then my expectation could be lower. And that's what I didn't explain, is that usually in climate finance and impact investing, due to the risk, investors require an additional, let's say, risk premium. So for the same risk that they would take, for example, in a well-tested investment strategy, and usually in developed markets, they will say with 8% upfront. But because it's emerging market, because it's new, then I need 11 or 12%. Even if you can show by providing data points, by providing researches, etc., that it's not more risky. They will say, no way, I have more perception of the risk, so I add this premium. And if on top of it you add another premium, which is this illiquidity premium, then you reach the 14%, which puts a lot of pressure on the projects. So we talk about impact projects. So when we talk about impact projects, it's not that they, by nature, will generate lower return, but they may generate the same return as a normal European project. But here we require them to let's say, generate a higher return, which may see some, let's say, what we call mission drift. And then the impact is not as good as we initially thought through. Because due to the high return expectation, they need to make some adjustments in their product. And that's not what we want in investing. So back to why blended approach is good. That thanks to these donor money, government money, DFI money, public institution money in general, we are able not only to blend the risk, but also to blend the return expectation. So that instead of having, let's say, 100 million of investors requesting 10%, I have indeed 18 million requesting 10%, and then 20 million requesting 2%. So then now I have a lower pressure on an impact project to generate the return. And it's a bit the same exercise here on the top. To be able, so let's say you're a private investor, you're investing into this forestry fund, and the fund generates an expected return of 8%. To get the guarantee, if you have to pay a high price for the guarantee to be able to exit, let's say 3% on an annual basis, because you receive a guarantee, so there is a premium for the service that you receive. If you have to pay 3%, then de facto you start from scratch with a 5% return expectation. Yes, you have an exit option, but still you have a 2-year return. So we had to work with many public institutions that are happy for the impact that would be generated by the facility, then are happy to support such facility with a relatively low return expectation. So the money coming from the governments, from the DFIs, and from the public guarantees, guarantors are coming with a relatively low return expectation than just simply enables this facility to happen. So sometimes not only it's about protection from a risk perspective, the first loss here, without this it will not fly, it would not happen. Some investors would say, no way, the banks will never give us the required credit line if they're not protected. But also it's a mix between risk aspect and return aspect. Here, as I said, it's a bit more indirect than what Jay and Sandra are doing, but it's the same mindset, always the same mindset, attracting more private investors, thanks to the benefits and the advantages of the blended finance approach.
Thank you, Arnaud. Jay.
Yeah, so I go back to the original problem that we stated, which is why we tried to use blended finance to solve the problem, which was before we started the craft fund at Lightsmith, there simply weren't any private, believe it or not, any private investment funds focused on the adaptation and climate resilience problem. And there are a number of reasons for that, one including nobody knew what that meant. Nobody knew what adaptation, you don't go buy a loaf of adaptation in the morning, you don't fill your car with a liter or a gallon of adaptation. What does that mean? How do you do that? What do we really need to invest in? What are the examples that actually demonstrate to you that there is a business model that makes sense, that's investable, that's scalable, that can actually achieve the mobilization of capital and technology that's going to be required over the next several decades to actually make this all work? I wish I was adapting to this fly at this point. But so in order to actually achieve the critical mass to get to a first close and actually catalyze capital into the structure, some leading investors, like the Luxembourg government, like the Nordic Development Fund, like the Rockefeller Foundation, agreed to take that junior position and enable other investors that are commercial return-seeking investors to be crowded into the structure. And that successfully enabled that first close of the Lightsmith Craft Fund, the Climate Resilience and Adaptation Finance and Technology Transfer Facility, to occur and was announced at COP25. And that catalyzation was critical, enabling us to raise additional capital over time, because there's 3 specific risks that we're trying to overcome. The first was first-time strategy risk. There's never been an adaptation or climate resilience investment fund in the private sector before. How do you create the first one? Nobody really understands what the risk return profile looks like. What do you really mean? How do we explain what to do? How do we do that? The second risk was a first-time team risk problem. First-time funds are extremely difficult to raise because there's no track record, there's no history of how performance has gone. If you've never invested in adaptation before, how do you know what the returns look like? If you've never invested behind this particular team before, because it has never invested in adaptation before, how do you know how well the team's going to execute? And the final factor is really all those questions that we're now also facing in this environment, which is developing country, emerging markets risk. And so we achieved the first close with the catalyzation effect of blended finance on Christmas Eve 2019. Just in time to run right into COVID, where a lot of commercial investors who were interested in investing in the fund and waited for a first close to get to that catalyzed effect, suddenly faced a global pandemic. And I'll tell you, in year 2020, emerging markets capital flows and foreign direct investment collapsed by 40%. 40% of the capital came right out of developing countries. The risk was considered to be way too high. I think we're facing a similar capital outflow right now with interest rate changes, with volatility, with currency issues. And it's always very challenging to mobilize capital for developing countries and emerging markets, particularly in times of volatility. So those three problems, when Joan says you need to identify what problems you're trying to overcome with blended finance, were the ones that we were focused on. How do you overcome first-time strategy risk, first-time team risk? There's literally 1,000 teams out there right now trying to raise first-time funds. And then developing country risk on top of it, which has compounded everything else. So I would say without the intervention and the commitment of the Luxembourg government, Nordic Development Fund, Rockefeller Foundation, without that junior capital to catalyze that first close, there would never have been a craft fund vehicle. Now on top of that, when we look at the deployment of the technology, I would say that the Craft Technical Assistance Facility, which is funded by the Nordic Development Fund and the US State Department, is trying to overcome those in the deployment of the technology underneath it. The deployment of solar hydro panels into low-income countries and small island developing states without support for piloting, without support for the testing and deployment of those technologies on a grant basis might not occur on a commercial basis for a long time because there's much larger markets, there's more commercial markets, there's more affordable markets for that technology to be tested and deployed. But by the use of small amounts of grant funding, so this is a $4 million facility, we have a $500,000 project in Papua New Guinea. We're going to deploy technology for the first time in a small island developing state. So Source Global's hydro panels will supply 2 communities that are under enormous amounts of water stress compounded by climate change. With the access to those panels and proving out that business model, and we think of it almost as blended finance as a time machine, where you're going into the future and bringing the cost and capability of that technology back to today by deploying it immediately. And that unlocks the ability, once you can prove you can do water projects on a pay-as-you-go water basis and have the track record for it, you have the communities actually benefiting from it, you understand what it practically looks like on the ground, how difficult, how easy, what the risk and return is, that actually then unlocks your ability to much more scalable, large-scale products. So in a year from now, in 2 years from now, hopefully by COP37, there will be enormous amounts of already scaled technology. And the reason why I would say that this blending over time is really critical is this. If we thought about the world, during the financial crisis, 2008, 2009, just over 10 years ago, and you said, okay, the cheapest source of energy on the planet will be solar energy, and electric vehicles will be inevitable, most people would look at you like you had 3 heads. They'd say, well, maybe that's possible. Now those are considered to be inevitabilities. And the question is, what are the technologies we can pilot and deploy? What are the instruments we can bring to start the trend lines for scaling up those technologies and those capital flows so that in 10 years, a more adapted society with more food security, with more ability to deal with increasing extreme weather events, with water issues, with supply chain issues, with the healthcare impact from climate change, where the technologies and the capital that flowed into those to make our societies resilient net zero will look inevitable in hindsight. Small amounts of those initial steps are critical. The first fund for adaptation and climate resilience, CRAFT, we hope it'll be joined by hundreds or thousands of investment strategies, and that $185 million, we can easily see $500 million, $1 billion of deployment of capital, even in just the pipeline that we see right now ourselves. And again, that first set of technical assistance, it's a $4 million facility we could easily see at least $100 million of technical assistance for these kind of piloting and deployments that could be deployed and launched within the next year and then scale up thereafter. So that's what we think blended finance solves. The other barrier is time. Like, we need to get there faster. We're running out of time. We've run out of time. And so I think in thinking about what does blended finance actually do, it catalyzes that first event and it creates the trajectory, the pathway, so that we can actually scale up these technologies and the deployment of capital going out there.
Thank you, Jay. So we are, I'm checking the time, 5 minutes ahead of schedule, so I'm very proud. That's when you have such a good panel. But we will move into questions. So if there are any questions maybe here in the audience, we can take them now. We're still fighting the flies. Or if there are any questions online, we can have a look as well. So there are questions there. Should we move? Is there a microphone we can move? I mean, there's one there. I don't know how far it goes though, so maybe you'd have to move up a little. Thank you.
Hello? Okay. Just a quick one. I don't think anyone's in disagreement that this is exactly what needs to happen. A lot of different blended finance solutions. I think we understand the different chopping and cutting of finance and how it's going to be done, but kind of what you spoke about at the end there is how do we mainstream this in a quick way? Do investors have a role to engage with banks, with governments to get that DFI finance? Because at the minute, Holland, Luxembourg, Belgium have been doing this for these structures for quite a long time, to be honest. This isn't very new. So how do we reach that mainstreaming? And yeah, love to hear some thoughts on that.
I think it's a great question. How do you mainstream, or how do you bring institutional investors, other investors into the blended finance discussion? And I think some of that's been happening right now. I was at a panel discussion earlier in the MDB pavilion where the Asian Infrastructure Investment Bank, which is also an investor in the Craft Fund, was sitting next to BlackRock. And BlackRock is saying, look, we manage almost more money than anybody else. We do massive amounts of infrastructure, and we're now structuring fund vehicles where we're working with DFIs and governments to say if there's a risk mitigation factor, we can start to look at emerging markets and developing countries and begin to do that. So I think the two things I would say that are the calls to action, if I had any, for investors are the following. First, don't think you need to start big. You can start small, and that could scale, right? So getting involved in some of these new strategies like adaptation, like biodiversity, like natural capital solutions that may seem small right now or have the potential to scale up dramatically, but if you don't start, then they'll never get to a position where you can get to scale. You need a first step in this long journey that we're on. We're very happy that we have family offices, insurance companies, institutional fund of funds as part of the crowded-in capital and the craft vehicle at Lightsmith. We need many, many, many more of them, but those even small amounts of investment at this point are the beginning, enables the beginning of what could scale into a dramatically larger amount of capital. The second point is that it's worth engaging, and I think the simplicity aspect is one which is really important. I think it's worth having institutional and other investors come back to the folks that are trying to create these structures and blend them, and to give customer feedback in a way, right? And saying, look, it needs to be simple and digestible. We need to have the education be able to actually explain it. And I think vehicles like Alessandra's, where you have a fund of funds that enables you to invest across a diverse set of entities with global standards and reporting that simplifies the process for institutional investors is really important. A secondary market, knowing that if things change or your investment strategy has to be adjusted because you're a pension fund or an institution that actually has different reserve requirements, then you have an opportunity to get liquidity. Creating the conditions, explaining the conditions that actually would mobilize investors into capital. So I'd say the best way to do things is to start doing that. So start now, start small, be willing to engage, and then also provide that constructive feedback so that we can simplify that process. The thing that is the most challenging kind of metric that we face right now, the scarcest resource that we have is time. So the faster we can start these things, the quicker we can scale them up, the more simple that we can make the interfaces, the better. So I think things like convergence, I mean, Joan's ability to kind of bring best practice together, create a database of how different blended instruments actually work is really important. I would say, just as one point of view, I think there is what I call the left-handed screwdriver problem, which is we shouldn't just innovate for innovation's sake. Like if we take a screwdriver and fix the problem, you don't have to figure out that it has to be a left-handed screwdriver. There is no such thing. You can use instruments that work today, even simple blended instruments, to get quickly to scale. Innovation is about where you're pointing those instruments and the objectives. It doesn't have to be redesigning the instruments constantly over time. We don't have time for that anymore. We need to deploy capital quickly. So I'd say start now and give feedback.
So I have views on that subject as well. Blended finance needs to get to a point where it's large, repetitive, and boring. And the way you get to large, repetitive, and boring is actually for donors to do a few things, and for investors to do a few things, and for everybody to do a few things. So the countries that have the grant resources and the aid agencies and who sit on the boards of the multilaterals, they need to give some clear signals about their priorities. There is not a very clear signal at this moment about what that grant capital wants to do. There's no front door to knock on if you are a private sector investor and you want to go talk to a donor agency. It's not very clear. They also need to act together. More of this, where you have several countries all working in tandem with each other, would simplify things. Everybody needs to focus more on adaptation because there's not a lot happening yet. On the investor side, it's pretty important to get climate expertise built into your team. I don't mean hire a climate finance dude on your team. I mean every single person in your company knows what climate will do to your business model and what is investable and what could be investable. Get smart on climate, because you're otherwise missing the boat as an investor, and you're also not able to speak the language of the donor agencies and the philanthropic agencies who are trying to help. If you can't talk to them about why your transaction has impact on climate, you're not going to get their money. And everybody in the equation needs to get much more transparent about how things have gone. We get donor questions all the time. What is the impact when I put my money into a private transaction? We get private sector investors saying, has anybody ever made any money in these deals? And everybody asks, what was the level of concessionality that got this one, lit the fire on this deal? And we cannot answer those questions because nobody is sharing the information, even with field builders like Convergence. Until everybody figures out how to share it in some way that deals appropriately with their own commercial sensitivities, there's no feedback loop, and we're not going to get better at knowing how to put these things together, and we're not going to roll them out fast enough. So that's my view as a neutral party in the equation.
Maybe I'll just add to that, and then I'll hand it over to Alessandra. To the point that I had before also about the experience when we went to see the private bank, I think it was so eye-opening really to have that discussion right away. So I think one of the things we need to do more is holding their hands a little more. So really sit down with them and then explain how the models work, because they really didn't know. And so for people who work in this all the time, I mean, it's really low-hanging fruit, it's simple and it's easy, but they had no idea. And so they then, which is also interesting, they have two different buckets. So normally there's the private equity, ultra high net worth or high net worth individual private client bucket that can do like high risk investments in private equity or private debt structures. And then there's also the equity and the bond investments, so more liquid investments, which is really the trillions that we need to mobilize. And that's where the initiative that Arnaud is currently setting up, so October, is such an important initiative because it creates that liquidity where you can make the bridge between people who want to invest their money in equity or bonds where they can exit after 2-3 days easily. So they have that liquidity and make that bridge between doing investments where their money is locked in for 10 or 15 years, which most people don't want to do. Like my grandma or my mom, that's not what I recommend them to do with their money either. but we need the money from my mum and from my grandma to fill the gap to reach the SDGs in 2030. And that's exactly where that October strategy would come in. So it's those two things. It's this creating more liquidity for illiquid markets, and it's just taking the actors even more by the hand, which I really underestimated, because once you've done it, now we see that they have a keen interest. And the other thing, and Joan, you mentioned it as well, speaking the language. It was also very interesting because when we were done with the presentation, they actually said, we need a different presentation, because the one that we gave them, they couldn't give to their ultra high net worth individuals. They said, we need a different one where you do more storytelling, where you take them by the hand again, so where you say, the world has goals until 2030, we're not reaching them, these are the consequences of climate change, of biodiversity loss, of water scarcity. So where you really say, these are the problems, this is why we need the money, we'll invest it in these strategies. And so you need to adjust that language at the same time.
No, just to briefly comment on what has been said. So I think something that John said that is very relevant is access to data, right? So again, we hinted that, but in terms of measuring impact, right, what is important is to be able also to compare initiatives. And it's true that there is not much track record out there, but that somehow, if you want, in this sense, is an advantage, right? Because you can set certain standards and how to measure impact right now and make it comparable across different initiatives, right? So that also for the private sector to go back to the education and hold in their hands, they are able to compare different initiatives because we are measuring everything the same way. So I think in this respect, I mean, SFDR, the EU taxonomy, of course, are sometimes painful, but still they give like good guidelines that can be replicated and that can be used across the industry so that, you know, things come together in a nice way and are easy to understand for the private sector.
And can you hear me? Yes, you hear me. Okay, if I may add to these full answers already. I want public institutions to speed up, to look at what the Luxembourg government is doing. Within a few months, being able to hear about a new project and then discuss, have a lot of exchanges, and then taking decisions. I mean, we've been working for the last 15 years with pretty much all development finance institutions, European Union, etc. And Jay could also comment on this, but it takes years and years and years and ages of a new version of the term sheet, a new version on this, and question on this, and that I need to go into my risk department, my legal department, and it's, I mean, we've created together also with the Luxembourg government a climate finance accelerator, out of which Kraft was also a member and cohort. We see that there are a lot of good projects. I think public institutions should not be scared to take risk and just a bit like maybe a venture capital investor, private equity investor saying, I have 10 investments, maybe only 3 will succeed, but out of 3, I will generate the impact. And it's only by injecting quickly money into all these initiatives that will generate the impact. As Jay was mentioning, we don't have time anymore. 2030 is in 8 years. So you don't, it's not possible to wait for 3 years for a fund to be launched, like it is on all the funds that we have created. So to go join, hopefully we should shake all these DFIs and then governments and donors to say, try to simplify your process, try to make a decision more quickly, or outsource your decision process. And so maybe sometimes, and that's why this fund initiative is a good one, maybe sometimes it's faster because, well, technically they cannot do more quickly internally because there are 5 or 6 steps of decision making, which is not the case in Luxembourg, again. And so sometimes give a pot of money of concessional capital to actually invest through blended approach to a private institution which would have the mandate to do so. So maybe it's a call for action. Yes, for sure, we need to work on the private side, but if the public side could take a decision more quickly, we'll see many more projects well, popping up and being created.
Good. I hope that answered the question.
Exactly. I'm wondering if we answered the question or created even more questions now.
And there's another question. Should we?
Sorry, I'll go on this side. Thank you so much. And actually, it was just a follow-up question on what you're all discussing in answer. So I was interested in this reaction that you're getting from the private banks. So what you mentioned education, you mentioned holding by hands. Is there anything else that can be done to make it more known among the private banks? Because actually I'm just finishing a study where by interviewing some private banks, the feedback that I got for them is like, there's not enough projects out there where we can invest. We need blended finance. We need projects where there's some risk takers, and it makes it easier for us to invest. So it was like, now listening to this, I'm like, okay, so there's clearly people not talking to each other. And a second question linked to that as well is, do you see that clients of banks are demanding for this, or they're not aware of it yet?
I'll start and then you can jump in. I think you already said it. They're not talking to each other. We're not talking to each other. That's basically the answer to your question. Because whenever I do it now, when I go see the banks, but maybe it's also because then I'm from the Ministry of Finance and I come from I have a different hat. And then also, I mean, you know, Luxembourg's a tiny country, so maybe that helps as well. It's, you know, it's really small. Like it takes me 15 minutes to go to any of those offices, so that, you know, it helps. So yeah, I think it's not talking to each other, which we really, really need to do more. And I forgot your second, what was the second question? Oh, the clients. Yeah, so, I mean, chicken and egg story a little bit, but now what we've seen in the discussions is when you really sit down with them and you explain everything, it does work really well. So I think it really has to do with, again, simplifying the whole thing, and it's about storytelling. Telling them about the impact that their money can have, which comes with a lot of baggage in it, because then you have to explain what are the problems in the world. So you need to know a little bit about climate change, you need to know about biodiversity, you need to know about water, then you need to understand the financial system, then you need to know what sustainable finance is. Within sustainable finance, you need to know what is impact finance. To explain impact finance, you need to know the different instruments. So most people in the banks, they don't have those skills. They just don't. And so I think that's, again, it brings us back to education. So you really need to sit down with them and also provide them with the opportunities for to send their staff to educational events where they can learn about these things. And it's really stupid sometimes. Like what we saw now with the banks was they told us that the presentation you gave us, like this, we cannot give it to our clients because they're not going to understand, and it's not, and then we don't know how to explain the presentation to them. And so then they stop. Even though there would be interest from the clients to do it. And so now that's why we need to meet them more in the middle, where we go with them, and even if they can organize an event where they bring 10 ultra-high net worth individuals, you know, we will probably organize that now in January, and then it will be the government, it will be an asset manager, and we sit together with the private bank and their biggest clients, and then we tell them. So I tell them, listen, we have the SDGs, and this is where we're at, we're having issues, we need private money, this is what we offer as a tool for you to invest. And so it's, again, the storytelling that you need to do in order to really get those clients.
Yeah, maybe a few comments from Blue Orchard perspective. So a few years ago, we published, let's say, a study that it's called Blended Finance 2.0. Probably we should refresh it, but there are still some lessons learned there that I think are very, very actual and still applicable. So one of them, I think we shouldn't underestimate the private sector in terms of understanding, right? There are still, of course, banks that are not familiar with this type of impact investments, but there are some others that are also very sophisticated, and sometimes they make very to the point question that you're like, wow, which is very good. But you need to bring them in the conversation at the beginning, right? You cannot like make a product and then just say, take it, right? You need to onboard them from the beginning. You need to listen to their requirements. And again, I don't want to be repetitive, but you should try to avoid complexity, right? Because this is what doesn't make them buying the product and investing in certain initiatives. Another consideration that is in line with what we said before, and I don't want to contradict you, it's true that it's important to start small, but to start. At the same time, if you want the private sector, some investor will not be able to invest 5 million, right? They can only come in with 100 million, which is maybe the total size of your vehicle. And then it's an issue because they don't want to be the only investor, or they don't want to represent more than 20% of the total size. So it's true that we need to start from somewhere, but we need to scale quickly, because otherwise we cannot bring those investors that maybe are even those more sophisticated in terms of understanding the impact finance space, because they literally cannot place small tickets.
So I completely agree with that, and I think that maybe there's two important context comments to make from the point of view of our engagement with private investors, and particularly private banks. One of them is there has been a transformation in the climate space in private equity and venture capital, so private investment vehicles. And that is a dramatic shift that's occurred in the last 24 months, and I put a lot of it down to the Biden administration transition in the United States, at least in that sense. So if we were having this conversation 3 COPs ago, we'd say, well, you know, people are trying to raise money for climate change, it's very important. There have been a really terrible set of experiences around clean technology investing back in the 2000s. A lot of companies went bankrupt and so on. But in the last 18 to 24 months, over $50 billion, $50 billion, has been raised for climate-oriented venture capital and private equity. So there is interest, and people are now aware. And the question of, like, do you understand anything about climate change has now become a different conversation than it was even 4 or 5 years ago, because if you can choose what continent you're being flooded on, if you can choose what experiences with heat waves and fires, because you've experienced them yourselves, which is unfortunately now the reality for many people all around the world. It's not anywhere, no longer like this is a problem for 2100. Climate change will eventually be fewer polar bears and fewer coral reefs, and that's very sad, but that has nothing to do with me or my investment portfolio. I think the immediacy of the emergency is now, I think, being recognized by investors and other people. The difference is there's only a fractional amount of that $50 billion so far that has anything to do with emerging markets or developing countries. And so the question is, can you take instruments like blending and enable you to go to new areas, like taking what we're doing in developed countries and bringing it very quickly to developing countries, and expanding into new areas like adaptation. Like, you know, if you had to start with $1 billion adaptation fund, I think it'd be very difficult to raise that capital on the first go. But once we've proven the first $185 million or $200 million investing, you can raise capital that will get to $500 million, billions of dollars, the hundreds of billions of dollars that we're going to need to actually address the scale of the $1 trillion of scale of problem that we're going to have in the next 10 or 20 years. So I think one other argument to make is we should create a mechanism where you're staging the education of investors, where the initial launch phase of an area will prove out those things that will be needed for large-scale pension funds that can only do $100 million at a time to participate. And a lot of that's building that track record. A lot of that is demonstrating that you can actually make investments in new areas, like taking, you know, the climate investments you're doing in developed countries and bringing them to developing countries, having experience. A lot of the risk we're overcoming is perceived risk, but staging that experience with investors is very important. So I think there is inherent interest because the emergency is here and people see it. There is inherent interest because the next generation that's going to face all this for their entire lifetimes understands that and is extremely concerned about it and very proactive about wanting to align their capital and their investments with that. The question is, can we create a staging process by which you can ramp up and have liftoff for these airplanes and then fly them while you're still building some of them while you're trying to fly those airplanes. So I think there is hope, and I think that there's potential. The question is, can you compress the time? Can you make it happen faster? And can you stage it in a way using blending and other instruments to get to the finish line faster? That's, I think, the question ahead of us.
Thank you. So it's exactly 3 o'clock. So I think we'll have to stop here. I saw there was another question please stay. We can discuss still. For everyone online, sorry we also didn't get to your question. If there are really burning questions, you can reach out to the Luxembourg Sustainable Finance Initiative, and they can also send us the questions so we can all stay in contact via email. So thank you very much for everyone. Thank you very much to the excellent panel again. Thank you very much to the audience and your questions, and thank you very much to the audience online as well. Have an excellent rest of the day.